This is niche, but not really a niche because it's about 20% of the US housing stock. But there are a lot of houses across the nation that are move-in ready houses that are valued in this $80,000 or less. So real value, done with rehab, it's ready for sale.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Eric Hornung, and I'm accompanied by my co-host, Mr. Camping in the Rain himself, Jay Klaus. Jay, how's it going, man?
Well, I'm dry once again, and for that, I am grateful.
You were without a home, in the wilderness. What happened?
Well, friend of the podcast, Mallory, bought us concert tickets to go see my favorite band at one of their most unique shows that they've ever done, a concert in Cumberland Caverns, which is in Tennessee, a cave 300 feet below the surface. Amazing show, amazing acoustics, my favorite band, like I said, and she used this, Eric, to trick me into camping, which is something that I have very defensively tried to not do just about all of my life.
Yeah, you're more of a roof over your head kind of guy.
I can do cabins.
Have roofs.
Just the issue that I have with camping is just we've worked too hard to build homes to go back to living in not homes.
Yeah? Well, you might have a bone to pick with camping, but I have a bone to pick with you.
Okay.
So you were down in Tennessee. You live in Columbus. And on your way home, you decided to stop not in, Kentucky, not in Lexington, not in between Cincinnati and Columbus. You stopped in my city and went to Skyline and didn't tell me.
I think that's where you're wrong, Eric. I think we were technically stopped in Kentucky.
You were in the greater Cincinnati area. You were a 12-minute drive from my house.
Well, listen, it was not premeditated Skyline. We were driving back. We still had 2 hours. It was the longest drive back ever, by the way. I have no idea how this happened, but it just seemed like no matter what we did, our path home got slower and slower. There were accidents. There were cars on the shoulder. There were new routes. It just seemed like for 30 minutes, our GPS said 3 more hours. Anyway, long drive back. I had to use the restroom. Mallory said, man, I've been craving Skyline for a long time. I saw my opportunity. I said, let's get Skyline. And so we stopped. We saw literally a sign on the right of the road that said Skyline coming up. Actually, it said Gold Star. And we said, let's try Gold Star. But as we got off the exit, we saw Skyline and said, why would we try Gold Star? Seems like Skyline is the play. We stopped. We got the Skyline. We used the restroom. We got back on the road and we hurried home.
I want to lambast you a little bit, but that was such a good transition that I'm going to let you go with it.
Today, our guest is Jada McLean, the co-founder and CEO of Hurry Home. Hurry Home finances houses through shared ownership, enabling renters to become homeowners and offering a streamlined investment opportunity. Despite there being 3 million houses for sale in the bottom-tier real estate market at any given time, banks are unable to profitably originate mortgages for these properties. Hurry Home uses capital from investors to offer a new financial product that enables homebuyers to earn equity in their home while paying close to or less than what rent would be for the same property.
It just seems like you said it wasn't premeditated Skyline, but it definitely was premeditated that you were going to go through Cincinnati. You could have just, given me a heads up.
It's true. But I was hot. I was sweaty. I was still covered in from the day before's sunscreen. I don't like being wet. I don't like being dirty. And the faster I could get home and I could get to a shower, that was what I was optimizing for.
You are so full of excuses. It's ridiculous.
Hurry Home was founded in 2018. It's based in South Bend, Indiana. And also the founders split time in Chicago, Illinois. They've gone through Techstars. Eric, this is going to be a pretty early episode for a company, pretty early on in Hurry Home's existence. But we really like the model. We hadn't spent any time in South Bend, Indiana yet. And I think it's going to be a fun episode.
This feels like one of those companies that's not really going to have that bread and butter 6 to 18 months before a Series A that we look for. It feels like one of those companies that if this model works in the pilot stage, it's just going to absolutely blow up with a huge raise.
Real estate seems like real estate tech when it's not just software enabling things with real estate, when there are actual homes involved, seems like it becomes pretty capital intensive. If you look at Open Door, for example, big raises. Don't know if Hurry Home is playing in that space or not, but you've listened to every episode of the Bigger Pockets podcast, so I'm going to lean on you to suss that out.
All right, let's do it.
If you guys have any thoughts on this episode as we go through, you can tweet at us at UpsideFM or email us hello@upside.fm, and we'll get into the interview right after this. Hey guys, wanted to give you a quick note and ask for a quick favor. Eric and I have once again entered the South by Southwest panel picker competition to have a panel or maybe two panels at this year's South by Southwest Festival. Last year, you guys came out in droves and voted for our panel and gave us the opportunity to go and speak with people at South by Southwest about geography versus investing. Does location matter? And this year we have two panels up for vote that we would appreciate your help in supporting. Eric, you want to talk a little bit about your event?
Yeah, so mine is quite the tongue twister, Jay. So if I get through this in one take, it's going to be impressive. It's called Capitalist Running a Cashless Fund. I nailed it. It's about what Jay and I are doing here on the podcast, which is essentially running a venture capital fund without making investments of money, but instead making investments of time and giving people media attention. I think this idea can apply to a lot of other spaces, and we're going to tell our story and also talk about other ways that you can think like an investor, act like an investor without making specific investments. What do you got on the docket, Jay?
My panel is called Connecting Tech Communities Outside Silicon Valley. It's not nearly as fun to say as yours, but this is a panel exploring the ideas of how to connect community builders and different ecosystems across the country to one another. It's sort of this platform role for community that we've talked about more than once here on the podcast. And so if you guys wouldn't mind tossing us a vote, you just have to go to upside.fm/vote. I'll say that again, go to upside.fm/vote. Please give us a vote on both submissions, and hopefully one of them comes through, and we'll see you again this year at South by Southwest in Austin, Texas. Jada, welcome to the show.
Hi, thanks for having me.
On Upside, we like to start with a background of the founder. Can you tell us about the history of Jada?
Yeah, definitely. So I'm actually a Los Angeles native, born and raised.
I didn't know those existed.
Yeah. I'm actually, another fun fact is I'm the first person in my family born in the States. So my family is from Jamaica. And let's see, I went for university, I hopped on over to Duke, so totally opposite side of the country. My mom really hated me for that, but very happy because she can now talk about her daughter being at Duke. And then moved to New York, did a stint in investment banking, which my mom still has no clue what that means. So my mom's a nurse, my stepdad's a gourmet chef. Like they literally have no clue what I do or what I did. And that's kind of where I learned about entrepreneurship.
Where is how you learned about entrepreneurship?
And so in banking, I worked for a big kind of bulge bracket for a little while, and then I worked for a smaller shop. And the smaller shop, it was like, they call it middle market. So a lot of I was a point of contact for all the executive level companies we advised. And I just kept seeing them, come in and out the door. Like, and I was just like, you know what, you guys are smart, but you're not that smart. Like I could totally do this. And I just demystified the whole entrepreneurship or the journey of the entrepreneur and built up the courage to say, you know what, I could do this myself. And kind of spent the next 6 months just frantically writing down any and every problem I came across to see if there was kind of any opportunity within my own problems that I saw.
How long was that list of problems?
It's notebooks, actually. Yeah, it's notebooks on my end. It's also notes on your phone, kind of whenever like you wake up in the middle of the night, you're like, oh, this is kind of cool. Or it's just you're walking down the street and it's like, oh, let me just jot this down. And then you pick a few and you flesh them out or they're kind of things you do with friends sometimes. Yeah.
Did you ever do any kind of like side hustles or anything like as you were going through some of those ideas, like something that didn't seem super scalable, but you're like, I could try this out. This seems interesting.
A bit. It was kind of hard having kind of the banking hours to really pursue side hustles. And then on top of pursuing like a startup that I wanted to really go after. Because I think it was like sleep, real job, which is a lot for bankers. And then it was like, now let's do some customer discovery of this other startup that I was thinking about. And it was more, when I think about, I guess, starting a company, it was more of like, how can I make this the biggest company ever? And how can I create the most impact, which would make it also really big.
I was going to ask what types of filters you're applying to these notebooks of ideas that, you didn't really take the leap and go deep into one until, that the company we're talking about today. But what were the sort of filters you're looking at as, if this idea could accomplish this, then I'm interested in pursuing it?
Yes, I mean, some of the ideas were absolutely idiotic. I mean, and it was like, let me just write it down. I think, and then other ideas were probably more geared towards the financial space, because obviously that's what I was in, and like problems that I knew my family was facing. So I think I just probably put on a natural investment banking filter. It's like, how big is this problem? Is this a problem that like real people face? I didn't really want to solve problems of millennials or problems that just increased convenience. I wanted to solve problems that were real. And so I think that those are the filters, because the realness of the problem really, really inspired passion within me. And you definitely need passion to do these things, because otherwise I don't really know how you do it.
Well, you're sitting in South Bend right now. As of your story, you're in New York. So at what point did you decide to go to South Bend, Indiana, of all places?
Yeah, I know. It was a very abrupt decision. So I was, yeah, yeah, it's very, very abrupt. So I was in banking. I actually started another company in black hair care, my own problem, huge, huge industry, and still a very huge problem. But it was while I was doing that and kind of struggling with my team doing that, someone in my Duke network reached out to me and they're like, hey, Jada, there's this opportunity to do some research on financial inclusion, which is right up my alley, tickles my investment banker brain. And he's like, the catch is that it's in South Bend, Indiana. It's like, all right, cool. Spoke to the people in South Bend that were running the think tank. And after the first conversation, I just felt that I had to go there to do this. And so 3 weeks later, I packed up from New York and moved to South Bend, Indiana.
What kind of financial inclusion specifically were you think tanking about?
Yeah, it's mostly so all the it's what financial inclusion really means is how do we create products and services that can not only serve the affluent or the, I guess, higher income individuals of the United States, but also people in the lower income brackets as well. So I think some good examples would be, if you're familiar with like Chime, like how do we make banking much easier, and like to how do we support the underbanked people, so people that maybe use payday loans because they can't get credit cards and all those types of products and services.
Why are people underbanked?
Well, yeah, I mean, I think there's a lot of that's probably not a conversation for this, because it gets really deep. But a few of the reasons is sometimes a lack of education in that in the communities. It's like, oh, we didn't know that if you get a bank account, there's all these other things that you could do that it allows you to build up towards. Or there's like fees. There used to be a lot of fees with traditional bank accounts. It's like monthly servicing fees or overdraft fees, which a lot of people actually banks like make a lot of money on. And when people are operating in cash, sometimes they don't realize, or are operating kind of like at the brink, paycheck to paycheck. Sometimes those fees get to them and they'd rather just not deal with that and use cash. And then there's also some trust factors as well with these financial institutions, which I'm sure probably you guys can relate to some extent.
What happened in this think tank conversation that was so compelling in one conversation that you decided to uproot your life and move to Indiana?
I'm as one of my investors says, I am a very much so gut feeling entrepreneur. So I think we had a conversation. I really enjoyed the conversation with the founder of the think tank, and I think the fact that I was focused on financial inclusion was another part. It felt like they had built up a network enough for me to cycle through and learn from. So I think when starting a company, what you really need to do is steep yourself in and around the problem. So how do you talk to as many people that have tentacles on this problem? And they had built up a network of people that I could immediately out the gate interview, which for me, that allows me to accelerate pretty quickly. And if I wanted to start testing services, I could go and get those people's feedbacks very quickly and iterate. So it's kind of that whole lean startup type mentality.
So I just want to clarify my understanding of this. This think tank, Was the goal of it to launch a business coming out of the think tank? Or was this just a Washington, D.C., we're going to publish reports think tank?
No, it was more of the former. So it was let's bring together a bunch of people that have an interest in financial inclusion and also have an interest in starting a company. And we can give them a bunch of people they can talk to. And then we can also give them like some of the inklings of the problems that we've researched in this financial inclusion space and then just let them run. And that's what they did.
What was the organization that put that together, just out of curiosity?
Yeah, it's called Invanti.
And what's their goal as an organization?
It's to find people that want to be entrepreneurs that may not have ideas and kind of help them along that journey.
What year was this?
2017? Yeah, end of 2017.
Okay. So help us close the gap then. You have this conversation, you go there, at some point you start a company. So help us close the gap as to what that progression looked like.
Yeah, so I got there and about 6 months later, after kind of spending most of that 6 months just researching and talking to people, we then spun up Hurry Home and then kind of got some good traction. The city government gave us some cash to make sure that we could get it up and running. And then we got into Techstars Chicago. And then we packed up, moved to Techstars, and shortly thereafter got our first customers. And now we're operating in both. Well, we're operating in South Bend, but also in Chicago as well, offices in Chicago as well.
I want to talk about you said you're researching for 6 months and then all of a sudden Hurry Home. Like, what was the decision? Where were the other potential opportunities in financial inclusion other than where you actually ended up?
Yeah, so I spent some time researching short term or small dollar lending as well. So coming from Jamaican family, we do this. Let's step back. It's really hard to get small dollar credit, which is why payday lenders exist, especially when you don't have a credit score or you have a bad credit score. But I think there's a subsector of people that just don't have a credit score at all because they don't want to operate in credit. So I was looking at that sector of people. And I know in my own family, my culture, we do like family lending and saving together. So we all pool money together. And then 1 month, one person in the family in that circle gets it. And then the next month, another person gets it. So it's kind of this lending and saving circle. So there's other cultures that do it as well. So I was looking kind of at that as well. It's like, how can I scale that? How can I make this a system where I not only can depend on my own circle, but how can I extend that circle to other people, and what kind of metrics would I need to have someone essentially vouch for someone and to be able to lend money? So it was only it was housing and this one. And I think at the point where we started getting the city government said they would give us dollars to run a pilot with Hurry Home. It was kind of a no-brainer. It was like, this is the opportunity, this is the time, let's run hard at it and see where it goes.
So spell out for us what Hurry Home is and how it operates now.
So Hurry Home is a new path to homeownership, and we focus on small dollar mortgages, so small dollar houses, the less than $80,000 market across the United States. And what we do is we align the incentives of property owners, communities, as well as aspiring homeowners through shared ownership. And how we do that is it's a marketplace that connects these property owners that own these houses to families that want to own these houses. And we allow these families to accrue ownership with each payment that they're staying there, that they're staying and paying the landlord, because they are able to save landlords a lot on the cost of turnover and vacancy and maintenance and management. So eventually the family accrues 100% ownership in the house at the end of 10 years.
Is that $80,000 after repair value, or are these houses that are currently completely livable and people are living in them and they don't really need much updating?
Yeah, it's kind of weird. I guess for a lot of people that aren't familiar, that this is niche, but not really a niche because it's about 20% of the US housing stock. But there are a lot of houses across the nation that are move-in ready houses that are valued in this $80,000 or less. So real value, done with rehab, it's ready for sale. They are valued in this range. And the reason why this problem exists is because for banks, the processing cost for any mortgage is the same, but the profit only increases as the value of the mortgage increases. So naturally, a bank is going to want to focus on those higher dollar mortgages. It means more money. But the problem results is that now there's few to no home buyers without any mortgages. So those people keep renting. And then the people that actually own these houses are usually property investors. And they're stuck with these properties because the only other buyers of these properties are other property investors that are looking for really high yield. So they're likely to buy it like high discounts, upwards of 30%, so 70% of the dollar. So they just end up being stuck with these properties after the investment period.
Are these homes generally clustered?
I wouldn't say they're clustered. Maybe. So a lot of neighborhoods, like it's like in South Bend, the median house value is like 65,000. So I guess if you think that's a cluster, it's kind of, I guess, city-based, town-based. We find there's a lot of these cities and towns kind of around the nation that have like low median house values.
If I own one of these homes in South Bend that's worth $80,000 and I'm a property investor, did I buy it because I expect to just cash flow it on rent, or am I trying to flip it and realizing I made the wrong investment?
It's definitely the former. So you're buying it with cash likely, and you probably honestly bought it maybe as a foreclosure, as a tax lien or whatever it was, and you put money into it to get it to be that $50,000 to $80,000 range, or maybe you inherited it and you rent it out to get cash flow, and it becomes kind of a steady stream of cash flow for you. The problem only becomes when 10 years down the line, when you're like, oh, actually, I'm done being a landlord. I don't want to do this anymore. Can I get rid of this? And there's no one to buy it from you.
So it's not, if I'm the homeowner and I'm excited about Hurry Home, I'm excited about it because I can get out from under the responsibility of owning this property without just losing my shirt on the investment in the first place.
Exactly. So for the landlord or property owner, this is an awesome opportunity because they get a trusted, qualified tenant that's going to take care of the property. They have completely reduced stress from the management because this family is now in there saying, I'm going to own this, so I'm going to really take care of it. And then obviously with Hurry Home helping on that front. And then you also have a likely exit because this family wants to buy it. And we help them kind of manage their savings, or the savings that they accrue for you, plus additional savings to purchase that house at any given time.
If the horizon is 10 years that the renter then becomes the owner, is it just 10 years across the board? Do you adjust what the payment is to get it done in 10 years? Or how is that model determined?
Yep. So we adjust what the payment is to get it to the 10 years. So it ends up being slightly above market rate rent, but a portion of that is like a forced savings for the tenant that goes towards the purchase price of the house. That can also be liquidated if they decide they no longer want to purchase it.
How is this different than like rent to own?
I think the one key differentiator is that it's a lot more flexible for the buyer. I think in typical rent to owns, you pay into it, and then when you want to leave or something small happens, you leave with nothing. With us, that's not the case. You pay into this, we escrow a portion of that savings, so then we'll liquidate you for some of the equity that you've accrued, kind of lesser cost to replace you.
One question on a follow-up for the homeowner. What are vacancy rates like in this segment of the market in terms of price?
Yeah, so I mean, it's more, there is higher turnover. So that's a lot of our pitch, is that because there's such high turnover in this market, we save you, maybe a month of missed rents. We save you the cost of actually redoing the house, so doing a paint, doing carpet, replacing faucets, whatever it is. And that's a lot of the pitch. We end up realizing that can cost the landlord $3,000 in 1 year, which is a significant amount of savings over a 10-year period.
So if I'm a homeowner and I'm going through this and someone comes in and let's say they get 3 years in and they want to get out, and there's like something adverse happens, you have this escrow. What does that actually look like in practical terms as to like, what's the go forward from there for the homeowner and for the person who was renting?
Right. So as in the renter wants to leave, or there's something wrong with the house?
Either way, I don't know. I could see like a ton of circumstances where this 10-year thing just doesn't happen.
Yeah, definitely. So yeah, I mean, if the renter wants to leave, then at 3 years, the renter has accrued, it depends on liquidation at that point, but and how much it costs to replace the actual tenant, but they will be liquidated for a minimum of their down payment, which is 5% of the house's value. And then on top of that, kind of a portion of whatever they've saved the landlord over the duration of their 3 years. So kind of the number I said earlier, we save landlords approximately $3,000 a year. They would get probably 15% of that able to be liquidated.
How easy is this to explain to renters?
We basically say it's rent to own, but better.
So
very easy. Yeah.
Yeah. So to go back to my question, so if you're liquidating some of this, I'm trying to figure out, is there like an LLC that's formed where, if something broke up, now there's a new home owner that is a conjunction of the previous owner plus this renter, or they basically like returned some amount of cash that they had invested into it?
Yeah, we escrow the cash. So it's Hari Home just returns it.
I see. Okay. Man. So with a 10-year time horizon, you guys started in 2018. Like, what types of experiments do you have to see play out to know that this is going to work, and on what time frame?
Well, the biggest one is, are our renters paying their rent? I'd say that is the biggest one, or biggest, I guess, metric that we watch. And I can say that all of our renters have been paying their rent. And we think that, that's partly because we take a more holistic view of their budget. We make sure that this payment isn't no more than 30% of their gross monthly income. And we pull their bank transaction data to really understand the ins and outs or the cash flows. So that's the biggest thing, I'd say. The next one is probably, I guess, the churn. So how many people are saying, I want to stay for year after year in this agreement? And then the next one is, how are they maintaining the house? So are they actually maintaining routine maintenance? But that's kind of why why we tie the equity to the time that someone's in the house as well.
Do you have any numbers on churn or maintenance that you could share?
Well, we have a small collection. We're still in our kind of pilot, I guess. We started the end of last year. We have our first, 5 families placed. None of them have defaulted. So we've collected about 30 payments. So no churn yet. I'm hoping there's no churn within the first 3 years. Maintenance has been, so we do home inspections to help us understand what kind of maintenance we can foresee and start budgeting for. And there hasn't been any serious maintenance. I think there was a window that broke, which is like a $250 fix, which we have a piece of their payment that actually we do a forced savings for maintenance to make sure that there's money to take care of that.
When you think about, right now you have 5 families placed, but in the future you could have 5,000, 50,000, whatever, a lot of families placed, right? Do you think about that as kind of like a portfolio, like the jobs, for example, if half of the people are in the coal mining industry and that goes by the wayside, how sensitive is your business and underlying ability for renters to pay to like macroeconomic conditions?
So I guess how we look about it, we look at cities that have diverse industries and that definitely have demonstrated job growth. And then we do look at it from an individual perspective, is how long have you maintained your current job? Has it been 2 years? That's really the minimum. And kind of what has been the income that you've been able to secure with that job. And then the thing about the rents here is that they're not really going to be able to find anything much cheaper than these houses. Because if you like these houses, a $50,000 house is probably going for $800 a month. And so our payments are around $850. So they're not really going to be able to find anything much cheaper. This is probably their best their best case scenario. But yeah, worst case scenario, we'd have to find more renters, which I believe that there will be a multitude of these renters in the event there is a downturn looking to rent.
You said the pilot's with the city?
Not necessarily with the city. They've given us some cash to help us run the pilot. So they support us.
Why is that? Why would the city say, we care about this so much that we're going to put cash into it?
It's a serious problem. So, the benefits for the city is that we put more homeowners into the city. That increases the homeownership ratio. That increases taxes being paid. That increases kind of the overall integrity of neighborhoods, right? We all know homeowners care way more about their homes than renters do.
Who are your guys' competitors?
I'd say our most direct competitors would be, well, one, the status quo. So there's like one-off rent-to-owns that have been happening since the 60s. Wouldn't say those are commercialized. They sometimes get a really bad rep because they don't really follow any regulation. They're often pretty predatory. And then the kind of more recent competitors would be like a Home Partners of America, where they let you lease the house you want to own for 5 years, and then you have to go get a mortgage to purchase them out. And then similar to them is a Divvy Homes that popped up in 2018. And they let you rent the house you want to buy for 3 years, where you accumulate a down payment and then you have to go secure a traditional mortgage. So none of these work in this bottom tier market, this $80,000 and under market.
How do you guys make money in this market? How does Hurry Home make money?
Yeah, so we figured out how much savings we accrue for this landlord, and we take a piece of that. And that ends up being, it's a subscription fee. So we make about $70 per house per month, and then we also charge an onboarding fee of $750 per house.
How'd you get to those prices?
Well, a lot, like the savings. So I look at how much we save landlords over this duration, and I look at kind of what our expenses would be for onboarding these houses, and that's basically all we did. Was like, let's just take a piece of these savings. That's probably the most logical way for us, at least, to come up with a pricing model.
Is it either legal or prudent to take all the money you could have hypothetically in escrow across tons and tons of houses and try to make money on that?
Oh, so like investing it and making interest on it? That's definitely something we would probably look into, because I know that, like, doing money markets, I guess. Yeah, I think that's not what we're doing now, but that's a different, I guess that's another question for another day when we have that problem.
So I feel like I understand the type of city and the type of home that goes into this. Can you describe what you think your renters will be like? Like, what stages of life are they in? What's important to them?
Yeah. So usually I talk about one of our people, or fake people, but she's a real person. So Barbara, she is a nursing assistant. She makes $40,000 a year, about. She's a native South Bender. She's about 35, so mid-30s, has a kid, has been renting her whole life. Why she's doing this is because she wants a place for her family. She wants a very stable home. It's not that she's looking for an investment as much as she's looking for a home to raise her kids.
This is much more an accessibility play for people who can't access right now, to build up, like you said, kind of like integrity of neighborhoods. This isn't something that me, as maybe a more money-minded individual or like a investment-minded individual who is still renting, this isn't something that I'm going to try to necessarily take advantage of.
No, it's definitely for a first-time homeowner that's looking to live in this house and, yeah, just really live and invest in this house because they want to remain there.
How big is this opportunity? Like, how many communities do you see that Hurry Home could enter and do this in? And what does that mean for your business?
Yeah, so I maybe said it a little bit earlier, but this $70,000 or $80,000 and under range actually accounts for 20% of the U.S. housing stock. So that means like 5.5 million houses that are currently renter households that are valued in this range, that are single family, that are in our market. And so South Bend is an example where actually I think just like 21% of its housing stock is in this range. And South Bend there's many South Bends across the country that we can tap into.
When you think about going to market, you kind of have this supply side, which is the owners of all those houses you just mentioned, and then you have the demand side, which is the renters. How do you think about going to market at both of those?
Yeah, so we have a bit of, the marketplace issue. What we've done is we've built up a lot of the demand side. We know that there's a lot of people that want this. So we build up a kind of like pre-qualified list of residents that want to do this. And then we have gone to, I feel like landlords are much easier to convince when you say, oh, I actually have 30 people waiting to take a look at this house. And that's basically what we've done. It's a little bit of kind of filling the funnel on the demand side, and then the supply side comes.
I totally believe that's true. Do you have to find them digitally, like by getting in front of them and saying, hey, did you know you could own a home? Or could you like get them from the rejections of bank mortgages? Like, how do you actually compile that list?
What we've been doing, it has been a mixture of a few things, because I think we're in the stage where we should be testing everything, any and everything. So we've done some digital. We've done some direct mailers where we're like, hey, tenants, why don't you just ask your landlord if he'd be up for this? We've done some kind of local media that we've boosted on Facebook. That's actually done the best. Like, I think we had this little ABC 57 clip that was a minute long, and it was just me and my co-founder talking about Hurry Home before we even did anything, and people eat it up. It's one of those posts on Facebook that people just like put other people's names under. And then they also there's some trolls and stuff, but we have a great comment from one of the women it's one of our customers now. Someone that got declined put under the comment, like in capital letters, fake. And then one of our buyers, she said, no, they actually really do help you get a house. And it was amazing. Yeah, it was so amazing. So those things work a lot. I think the authenticity is a big factor and very important for our customers.
How high touch does it have to be from your team to work this out? Like if there's 20% of the housing stock is this, do you still have to land and expand in each market as Hurry Home, or can you deploy this and people can take it off the shelf somehow?
Yeah, I think, well, what we've seen from the buyer side or resident side is that it hasn't been that high touch. It's been, initial contact. They do pre-qualification. We were doing like a welcome call because it feels good. And then they go through the application, their bank transaction data, all that stuff. And then they go on visits. They pick the house they want and then they move in. And then on the landlord side, I'd say it's probably equal touch. We may have like a call with them to clarify some things about their house. And then we kind of send out a home inspector to do that, make sure it's all good and ready for a tenant and make the match.
How, even like the time to work with that homeowner and then to send an inspection, like that's an expensive activity at the start. You said you had an onboarding fee, so that probably covers a lot of it.
Yeah, it does.
Is there like a break-even period of how much time you have to put into a property for it to make sense for you?
I mean, most of it can be like through filters, can be like, I guess, pre-qualified, right? That we'll have a house and we say, okay, well, we know our buyers or residents are interested in this. We know that they're probably like this honestly is probably not going to pass a home inspection. So there's no point. We're able to minimize the amount that's spent on houses that we know won't qualify. And a lot of that's through technology. It's, hey, send us your house details. We'll take a look and let you know if it's a house that we think fits our criteria. It's kind of like a roof stock in that way.
So I want to turn this a little bit. You mentioned that you're in South Bend, but you're also in Chicago. You did Techstars Chicago. You have a network in New York. How is raising going to expand this? What's reception to the pilot like? What's the network in South Bend like? Just kind of talk to me about like what the future of financing this business looks like.
I guess, yeah, the network in South Bend, I'd say, is like obviously great for customers and operating the business. Unsure exactly what the network would look like for raising when that time comes. I definitely tap into a lot of my network in Chicago and New York because I think New York is more heavily focused on fintech, and there's definitely people interested in not only fintech but solving the affordable housing issue and interested in how can we come up with new ways of funding mortgages or houses. Same with SF. I'd say there's some good amount of interest in affordable housing, especially looking at Divvy Homes. They've raised a ton of money from Andreessen Horowitz and maybe PayPal. I'm not really 100% sure. But I do think that there has been some really good perception of what we're doing. And people are really excited to see us. People were really excited to see us get our first customers and definitely interested and invested in our growth over the next, 18 months.
What did you get out of the Techstars experience?
Yeah, the Techstars was an amazing experience. I think, especially as someone that, maybe have a bit of a network in New York and met everyone there is to meet in South Bend. I really needed to build a network in Chicago because Chicago is, I'd say, like a Midwest headquarters, especially for startups. That's where there's a good amount of funding in Chicago. So Techstars gave me all the access I needed to all the people in Chicago. So I now say that I have a very robust network there. And if there's anything I do want to learn about or anything that I'm struggling with, there's someone that's just a call away or like 10-step door away.
What does Hurry Home look like 5 years from now? What's your vision for it?
Yeah, Hurry Home looks like we're in probably too many markets I couldn't even count, didn't even know about. Definitely probably in excess of 20,000 transactions. That's all I really would hope for, is that we were delivering homeownership and that we have no huge lawsuits. That's the big one.
How about from like an experience perspective on both sides of the market? What does it look like 5 years from now for someone who has a home to experience Hurry Home? And what does it look like for the buyer to experience Hurry Home?
Yeah. So for someone that has a home, it is, I think at the 5 year mark, they've gotten really comfortable with being a homeowner and have really integrated within their neighborhood. I think their neighborhood has, so one of the metrics we use is that if a neighborhood has greater than 65% homeowners, it's deemed a healthy neighborhood. So in all the cities that we're in, we'd like for those neighborhoods to be at that 65%, because that means that kids are probably running on the street. That means that there's other infrastructure being built around the neighborhood to support the neighborhood, and that there's other probably money and other investors coming into the greater city as well, because we've made it such an attractive place for people to live and grow up. And then I guess on the property investor side, I'd hope that their experience is, we've actually had to be very hands off. We don't really interact with the resident. We have cash flow coming in every month religiously. And if there's problem, Hurry Home handles it. And I'm very happy with the returns I have. And I'm looking forward to seeing this family purchase the rest of my house.
I'm going to ask one more question on a similar note. So let's pretend that the homeowner hasn't started with Hurry Home and the home, the tenant, the potential home buyer hasn't started either. 5 years down the line, how do I become aware of it? And how do I actually interact with you as the business or the software to make this transaction happen? What's the journey look like?
Yeah, so you probably become aware of it through friends of friends. Maybe your friend that lives in the same neighborhood as you was like, hey, I actually just moved into my new Hurry Home. It's awesome. You should totally do it. It's totally accessible. You could even use your tax refund to pay for your down payment. And they were like, okay, cool. They'll come online. They will get pre-qualified and go through the whole qualification process, which should take 24 hours. And then they will be able to access the listings of homes that are in their neighborhood, maybe even next door to the person that suggested they do Hurry Home. They put down their down payment after they visit it, and then they move in. And on the investor side, they have gone to Hurry Home, probably saw it, probably heard about it from a realtor or heard about it from, I guess, one of our like business development kind of salespeople. Saw it on potentially like a REIA, so real estate investment association type thing. And it's like, cool, I'm actually in the market for a new property manager, but this actually seems like a better way to go with my property. And there's a little social value. And they put their house on the website. We say, yeah, it's a great fit for us. We list it, and 2 weeks later, we choose someone to live in their house. And they just start receiving money in the bank.
How big is your team right now?
2 of us are full-time, and then it's myself and then John, and he is my COO. He does lots of the operations on the resident tenant side. His background is in like microfinance and housing, as well as other social tech ventures and marketplaces. So he's a product guy. And then we also have some tech that we work with as well. Aren't full-time yet, but hoping to make that full-time in the near future. And they've helped us build out, our initial kind of underwriting and buyer qualification systems.
Outside of the tech, let's say you raised a round of non-dilutive funding for whatever reason, and who would be your next big hire?
My next big hire is a digital marketing specialist. And that's mostly because we really need to understand, blow out the funnel here in South Bend, but also start understanding the nuances of marketing in other markets in Indiana, but also in Ohio.
I don't ask as many crystal ball questions. I don't usually ask this many crystal ball questions, but I feel like I want to for some reason. So if, let's say 5 years from now again, let's call it 10 years from now, if Hurry Home no longer existed for some reason, what would be the reason that it didn't work?
The reason it didn't work, I think the only thing that can really break the model is defaults, right? Because that's the value prop, is that we're saying these residents are very good residents. They have a demonstrated track record of paying rent, paying utility, and being responsible. And if for some reason that is not the case, then our supply side doesn't get the value.
It just goes away. So the risk is the tenants prove to be bad tenants, and so people say, I don't want to be on that platform because my tenants suck.
Yeah, exactly.
But there's no real loss in the system other than like just trust on the supply side.
Yeah.
People aren't like necessarily losing more money. Yeah, because it seems like there's not a lot of risk here for people to try it out. And if in aggregate it works, it seems like a resilient model.
Let's hope so. I mean, only time will tell.
Is there anything we aren't asking that we should be asking?
I feel like some people ask a lot about, the marketplace risk. How long does it actually take to make this match? Which I think is a serious question. And that's something that we are pretty laser focused on. I think in the deals we've already done, it's been as quick as 1 week, but it's also been as long as like 6 weeks. So I think the sweet spot is, can we get it in that 2 to 3 weeks range?
If I'm a property owner, I'm probably not exclusively listing it on Hurry Home, right? I'm probably still listing it on rental sites. And so the question is, can I get a quick enough compelling offer to sell the home versus continue to just rent it?
Right, exactly. Assuming that, someone would buy it at a price that you deem reasonable.
And so what's for most property owners who are renting now in these markets of $50,000 to $80,000 homes, what's the matching time for them with standard means right now?
Yeah, so I would compare it to like a property manager. It's like, how do we match the times of property managers? And that can be from 3 weeks to 2 months. So I think for us, our goal is, can we fill these houses in 3 weeks? And I think that will be sufficient enough for any landlord.
One more question then on user behavior, people who want to rent the homes. If I'm buying a home just as me right now, and I'm looking at a standard home purchase situation, I'm super picky. I'm looking for like the best thing that I can. How sensitive to small things, or like how picky are people in this situation?
I'd say that from the people that we know, there's one of our customers, she was renting the house that she wanted. So that was 2 of them, actually. Very easy. Renting the home they wanted. And then another one was very picky. I say she saw probably 15 houses. That's something we learned a good lesson from. We would curb that. I think we would try to go the typical realtor route, where it's like, we show you 3 or 4 houses, with the best one being in the middle. And then I think others are probably more in that 3 to 4 range. They'll see 3 to 4 and then they're pretty happy. We know a lot of families prefer like a 3-bedroom or a 2-bedroom basement. So we know the some of the amenities that sell pretty quickly. And as long as they have kind of those big things, families are pretty keen on moving in.
Awesome. Well, Jada, thanks so much for taking the time. If people want to learn more about you or Hurry Home after the show, where should they go?
Feel free to shoot me an email at ceo@hurryhome.io, or you can connect with me on LinkedIn, Jada McLean.
All right, Eric, we just spoke with Jada McLean of Hurry Home. Where do you want to start? Do you want to start opportunity? You want to start founder? How are you feeling?
I want to start with a fact that I was just so completely unaware of. 20% of the U.S. housing stock is valued at or below $80,000. That's wild.
Living in Cincinnati as you do, and me living in Columbus, that probably feels very strange to us in pretty burgeoning housing markets.
Even in Cleveland, I feel like when you're just kind of looking around properties, you don't really see much under $100,000. So it's crazy to me that there is so much that is that inexpensive.
I like this path. As I said in the intro, you've listened to every episode of the Bigger Pockets podcast. And so being someone that's much more learned in terms of real estate, what else stuck out to you here?
I guess I never really thought about the incentives of mortgage issuers to issue on the larger and larger houses. Like, it's not worth it to them to issue mortgages for a $60,000 house because of just the way that the incentives and the fees and the percentages are all set up. It's something I never really had thought about. I figured any volume they could get, they would want. But it seems like, no, we want the bigger ones. We want to go bigger and bigger.
Similarly, and this did not come up in the interview, but dating a realtor, there's not a lot of incentive for a buying or selling agent to get involved here either, because their commissions are based off of the size of the closing. And so I wonder if there's even a gap of education or accessibility for people trying to get into these homes, because they're not going to be working with probably the best realtors, because why would they spend their time there?
Right. The system is set up so that 20% of the housing stock is essentially underserved. That's wild.
Wild. And also wild to me that all that being true, I didn't find any true competitive companies to what Hurry Home is doing other than traditional rent to own, which I don't know a whole lot about. It seemed like a great idea conceptually. Like when I think of the idea of rent to own, it's like, yeah, that sounds amazing. Why wouldn't I want to rent to own? But it sounds like systemically that process is not done in a way that really favors the renter in the beginning. It sounds like it's kind of predatory. Do you know much about this?
I have a little bit of insight around it. I know that in the most recent Dodd-Frank regulations, they kind of chopped back a lot of the predatory stuff to the point where rent to own became less prevalent than it used to be. But there was also, I think it's just like loan sharks. They get to do something that is technically legal while feeling very illegal. And I think rent to own was kind of in that same bucket where they could take some liberties, they could take some excessive fees that on a percentage basis are huge because it's small dollar values. So it always felt very predatory when you're paying hundreds of percent interest or hundreds of percent in fees, but you're buying a $60,000 house. So if it's $1,000, you're at like 2% of already. So I know that there's some political issues around it. I'm not the most well-versed in what they are.
Let's keep following this thread and dive into the opportunity here first before we talk about Jada as a founder. I really like the model. If it works, to Jada's point, what she needs to see is, are people paying their rent payments? Because if it works, it seems like both sides really win and that there's not really a risk to trying it out. If I have this home and I'm trying to sell it and I'm having trouble selling it, this seems like a good means of doing that. And if they didn't pay their rent, you're not in much of a worse off spot unless you keep trying to sell your home in this way and it keeps happening that people aren't paying their rent. But it seems like as long as people are having a good experience on both sides, this is a really good option for both sides and the model really works. What scares me is just the lead time to figure that out.
Yeah, which is why I think they're in a pilot phase right now. I really like the model as well. So we're anchored to like 5.5 million houses. I don't know exactly how she got to that number, but there was a report that just came out last week that 40% of US households are owned free and clear, which means they have no debt on them and they're just owned by the owner. I don't know what percentage of those 5.5 million are rentals. I don't know which percent have landlords. I don't know which percent are just owned by these people who are sitting on the houses and will never be a potential Hurry Home customer. So I have a little bit of a difficult time addressing this market in terms of the supply side directly. That being said, it's a large market.
It seems large. The model is clear, charging $70 per house per month to the landlord who is using Hurry Home. I don't know if there's any risk of the landlord going outside of the platform or like using the platform to find buyers and then going outside of it. It seems like the software does play a really convenient turnkey solution to getting paid on the landlord side. So we'll just set aside that brief shadow I had in my mind. That seems clear to me. Difficult to build a marketplace in anything. And to her point, can we fill houses in 3 weeks? Can a landlord find a buyer that wants that house in a short period of time more successfully than putting it on the MLS or going through Zillow or Redfin to find a buyer outright? That's the bet. And, we have this pilot to try to figure it out. What did you think about the model of we adjust the payment to be a 10-year time horizon for all homes?
I think it makes sense from kind of both sides in that you don't want it to be too short because then the costs are going to be too high for the renter. And you don't want to be too long because then the return is going to be too low for the landlord. So they got to find a middle ground. I don't know if it'll stay 10 years or if it'll move. And that's kind of one of the questions I have about this model is pricing. Is it going to move? Where's it going to move? The payback period. Is it going to move? Where is it going to move? And I think you'll get some of those answers from the pilot here. One last thing I want to mention on pricing that I have a bit of a shadow about is when you think about landlords, there's almost always the option for a landlord to have a property manager. The industry standard is like 10% of the door price. So if rents in this unit are $700 a month, then the property manager would get $70 a month. In the forums and stuff that I've been a part of and the podcasts I've listened to, most people who are investing as an investor are hesitant to hire a property manager because that eats into their margin. So if this is seen as a substitute for a property manager to decrease vacancy by the landlord, I would be curious just to see what feedback is in terms of the price point and interest.
I think she mentioned that with a 10-year time horizon, their math so far has led to slightly above market rates in terms of rent.
Right, so that's on the revenue side, but on the cost side, they're charging something as well. So if you have a property manager and then you have Hurry Home, now you're at almost on $700 rents, you're at 20% of your rents going directly to third parties before you have to pay for all of your other costs that go along with the building, paying off a mortgage if you have one, and just as an investor, getting to your net operating income.
So let's transition here into Jada as a founder. She mentioned that she had the path of being a Los Angeles native, going to Duke for college, investment banking in New York, and then looking for problems to solve. She had started a company in hair care. What did you take away from Jada's story as a founder?
I think the most telling thing about Jada was just her ability, like mental hurdle overcoming ability to just move to South Bend, Indiana because she found something she really liked and enjoyed. Like, as someone who's from LA and lived in New York and went to Duke, like, you've been around like big kind of name places. She was at a bulge bracket in New York. Like, that's the creme de la creme of graduating with a finance degree in terms of prestige and what you want to do. So doing that, and I'm sure it wasn't like mentally easy to leave that kind of lineage to go to South Bend, Indiana. But I really enjoy that she made that leap and made it so quickly.
And it's clear that she cares about the problem. Like, it seems like she was taking a real intentional lens of, okay, I want to solve a problem. I want to start a company. I have this notebook full of ideas. Got presented with the opportunity to do this think tank and learn about this problem and said, you know what, I think I'm going to solve that, preceding that move. I really like that. It's really her first major swing of the bat at starting a company to this scale. Got into Techstars Chicago, which is a great sign. This seems like a big problem, a big opportunity, a wicked problem. So I like the audacity, and everyone's got to start somewhere. So, you can't hold against somebody the fact that they've never done a company this scale before. Everyone starts somewhere, but we have some founders on here that it's their third company they're starting, and they've gone through this song and dance before. And for Jada, it's not. Yeah,
I don't think I have that same reservation. I think she has the capital markets background. She went through Techstars, so she probably picked up a ton of the entrepreneurial stuff. I think she's in a pretty good spot to launch this, even though it is in a place that is large. And you hear a lot of VCs talk about how they've been burned by real estate tech before. So it's a hard space, but I don't think that being a first-time founder, for me, is a shadow of any sort. One last thing I want to mention that I'm excited about as an opportunity is taking this financing model and assuming the pilot works and assuming they can build out a bit of a marketplace. I think that there is a huge opportunity here in terms of the education space and like a community space on the front end for onboarding people into this space. So creating a way and a kind of a program, if you will, or a game, if you will, to get people to the point where they can be onboarded and be that pipeline funnel for them. Assuming they can do this, I think that there probably isn't as much targeted at this demographic. You have the FIRE movement with like the Mr. Money Mustaches of the world. You have the Bigger Pockets movement, which is at real estate investors. You have the FinTwit movement, which is mostly geared towards people who, when you look at a wealth management or financial advisor, most of them are taking people who are either millennials and potential high income earners, or they currently have a net worth of over $250,000. So I think this is a really underserved financial literacy area as well. And there aren't many communities out there geared towards that. So you can really own the pipeline of potential customers for Hurry Home in the future if you can get this financing model to work.
I wonder how, I don't have a backstory on how Airbnb really grew into other markets quickly and defended off competitors. Because this is going to be something where you launch in a city and you need to get density in that city for the marketplace to work, or people won't find their homes in that 3-week period of time, yada, yada, yada. So you're going to have to spend a lot of time in each city you go to. I wonder what it looks like to really spread this quickly and ward off hurry home, competitors, people who are seeing the model, seeing that it works and doing it in their own communities. Because the geographic density is really, really important for this working in any one market. And then scale across the country, what do you think about that?
I think that kind of plays into what I was just saying. You can use an online community to spur interest and name recognition for Hurry Home. So when they launch in your market, you've already onboarded 100 people into your methodology, your thought, and everything, rather than Airbnb, which just needed supply and was competing on price and was competing on locations and all of that. I think this, yes, you'll have to get the supply and demand. And like I said in the intro, I think this is going to be one of those things that if it works, you're going to see a monster capital raise. You're not going to see some small capital raise. But you could digitally create a community that onboards people for when you're ready to move to their territory. You already have a community of people who are advocating for you because they're learning through your platform. So what are you looking at in the next 6 to 18 months for Hurry Home, Jay?
Really just looking at the success and learnings, I should just say learnings from the pilot in what that means for their model going forward. Are people still paying their rent? Are both sides of that pilot, the homeowner who is selling the home and the renter who is buying the home, are they both still enjoying the experience? And then also, what does scaling this look like? What does their go-to-market plan look like? To the question I had just asked about warding off competitors and kind of going, are they following your content plan and following your digital community idea, or do they have a different plan?
And for me, it's something that might not even come true, but I want to look at the plan, the idea, the pilot, all in the context of the macroeconomic environment. So this is a little bit of a weird one, Jay, because unemployment's at an all-time low. And if we see unemployment rise or there's any type of recession or anything that happens, the cornerstone of this model is that renters pay rent on time. So if they have 2 of their renters lose a job, are they still paying rent on time? Is this a resistant model, or is this model subject to macroeconomic changes? Maybe 6 to 18 months is too close of a time frame. I'm not calling a top or anything. We're at all-time highs on a lot of things, so I want to think about how this model exists in changing economic climates.
It'll also be an interesting time to look at their fundraise and what that looks like. Are they planning a big raise? All right, guys, we'd love to hear your thoughts on Hurry Home. You can email us hello@upside.fm or tweet at us at UpsideFM. If you are a homeowner or a home seller who is in this market, who has homes that are less than $80,000, we'd love to hear from you and hear your take on this. So email us hello@upside.fm or tweet at us at UpsideFM, and we'll talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter @UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside Podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep on rhyming, find a way.